This
Yeah,
meeting
you
is
can
being
do that.
recorded.
No.
Good afternoon, everyone. I guess we'll wait for another couple of minutes for everyone to join.
Hi, yes, good afternoon. Hello. Hello.
Hello.
Hello.
Can you hear me?
Yeah. Now
Yes,
audible.
sir.
So good afternoon, everyone. How are you?
Good
Good
afternoon. Thank you.
afternoon. Yeah, good. How are you?
Afternoon.
Good afternoon.
I hope the day is going fine. Yeah. Okay, I'll just start with a brief introduction about myself. My name is Yash Gupta. Currently, I'm working with KPMG India. I'm working in the domain of CFO advisory, and the clients which I've been handling are of the industry of telecommunications, e-commerce, pharmaceutical industries, consultancy, FMCG, and like segments. Currently, I'm serving with the CFO advisory domain, in which we make sure the reporting and the accounting information which we share with the users of the financial statements is such that it is very much specular and correct in part, and make sure it is ethically correct. For this session we have right now, I would just request everyone to make sure that we just keep the mics muted for some time so that we can have a proper Q&A round at the beginning. So not at the beginning, basically in the middle or somewhere at the end of the session. Are we clear with that?
Yes.
Okay, let's start now. I'll just make a few adjustments and then we can start in. All right. In this session, we'll be able to get an understanding of the accounting process, basically how the accounting information, be it a large organization like an MNC or the global organization, or a small local dealer, how exactly the information is processed and end user gets the information for its understanding. Users of accounts, accounting and the bookkeeping. Basically, the accounting is just an extension of the bookkeeping part. There is few important financial terminologies, accounting concepts involved. There's a more important qualities of accounting information which we need to make ensure that we have to keep in mind by making the accounting information intact for the users of the financial statements. There are some users of the financial statement which can be internal and external to the organizations. We'll keep account of that as well. Then we have the gap. Gap is basically once we accumulate the entire accounting information, be related to purchase, sales, assets, liabilities, but make sure that the entire information is accumulated in such a way we follow a standardized information so that the user sitting in India can understand that information all over the globe. That is the gap, generally accepted accounting principles. Then we have this understanding of basic accounting equation, which is assets equal to liabilities plus assets. Assets plus liabilities is equal to equity. Multiple equations involved with there. Accounting principles and conventions involved. Then we have a proper walkthrough of the financial statements of the listed entity, that is Airtel. So here we go right now. The moment we get in this term in our mind, that is accounting, we ask some questions. Why is the accounting required? Who needs accounting? When is the accounting required? Be it a very large organization like an MNC or a global organizations like Reliance, Tata, Adani, any other big GSK enterprise, or a local enterprise in the local shop, everywhere accounting information is processed for the users to make sure some strategic decisions can be made, be it big or big small. So going by the basic equation or the meaning of accounting, accounting is a process of recording the transactions wherein we record the transactions related to sales, purchase, expenses, liabilities, classify these transactions into multiple accounts. We'll understand about the briefing about the classification in the further slides, summarize the information, analyze and interpret the information of the business for the benefit of the management and those parties who are interested in the business. Going by the basic definition, be it a large scale where like in the global organization, there are 50 chartered accountants, more than 50 chartered accountants, CPAs involved and MBAs involved. Over there, we are having this discussion and preparing the accounting information. And there are other hand, we can have this local dealer shop in the next to our office or a house nearby, where there's just only one accountant handling the entire information. The scale depends on the volume of the business. We have the purpose of accounting, which can be classified into 4 major segments. We make sure that accounting information is systematically recorded so that further information can be processed. We make sure that the presentation of the complete picture of the organization, what is actually happening, the losses, quarterly, 6 monthly, and annually, or the profits that we are making, to make sure that some important decisions can be taken. I'll just give you some important information with some examples on this presentation of complete picture in the further slides. There are statutory requirements to be made, as we all know that in the year 2017, we had the introduction of GST compliances, where all the indirect taxes were subsumed into this particular segment. Accounting is basically a language of business wherein we use that information from the user's perspective, be it internal users or the external users. Next, we have the need of accounting information. The accounting information by the investors and the internal and external groups want the answers of 2 major questions. How well did the organization perform, which is basically the profit loss statement of any entity, which can give an answer to this question. And where does the organization stand? And this question is having a brief introduction, basically more idea from the balance sheet that we study on the organization's balance sheet. Accounting process. If we consider the accounting process that we have in hand, we identify the events and transactions. In the further slides, we'll get an understanding what is an event and what is a transaction. An event can be commercial, non-commercial, but transactions always have a monetary value attached to it. We record these transactions, classify these transactions, and summarize them into multiple books involved, which could be journal, ledgers, cash book, sales book, purchase book, and from those books, we prepare the trial balance. By those trial balance, we communicate that information by preparing the accounting reports. And these accounting reports can be the balance sheets, profit and loss, cash flow statements, statement of changes in equity, and the notes to the financial statements. Once these entire information has been prepared at the standardized level, following the standardized principles that we follow all over the globe, which can be the Ind-AS reporting standards or the IFRS, we analyze and interpret these information for taking strategic decisions at the global level. These decisions can be at the management level, can be like if we have multiple lines of business involved in a particular business. And using the strategic edge of one line of business, we can use that benefit to expand or conglomerate with the another business to make sure the benefits of one line of business can be taken to expand in the multiple market segments. With this, I'll be giving this example of Dharampal Satyawal Group in the further slides. The users of accounts. There are multiple users of accounting information involved, which can be the shareholders, investors, which is obvious the reason why they have this accounting, need this accounting information to make sure that the investments made in the company's accounts is intact. There have been multiple fake claims and frauds that have been happening in the market, like the famous case of Satyam's case, where the share market had fallen drastically after the CBI made an investigation and information that was revealed that 7,000 crores of manipulation in the books. There are customers involved, that is the end users of the product. And we need to make sure that not just a good quality of product, we need to make sure that they're delivered to them. We also make sure that the after sales services and the benefit that they get from the value that they expect from the information is delivered to them. Sorry. There are suppliers involved. Suppliers are the one who provide us the raw material, fixed assets, fixed goods, finished goods, and the WIP material for the procurement part, and make sure that that information is product is available to us for further processing, and that product is sold into the market. So, for some suppliers' perspective, the information that is required includes that to make sure that the dues of these suppliers is paid in due time, and there's no much delay in this reporting part. If we just go ahead with the reporting part, there have been reduction in the Companies Act, wherein there's a requirement to add that aging of these schedules, the supplier's perspective and the trade receiver's perspective. Then we have the tax authorities. These tax authorities are the state or central authorities which can be with respect to the GST compliances, customs, multiple other taxes, the local taxes, multiple taxes involved to make sure that these taxes are paid in due time. And non-compliances of these taxes can lead to a very bad image of the organization. So this information is very much particular to these tax authorities. Then we have the lenders. Lenders are the financing operations of that particular business which provide the finances for the company to run. This lender is usually in the form of debt obligations of the company that on the basis on which the company runs this organization. It is basically the fuel of the organization on which the operations of the company run. Then we have the employees. Employees can be in basically the three levels: the management structure, execution structure, and the middle level. Employees, from the employee's perspective, accounting information is necessary to make sure that the dues are to these employees are paid in due time. There's no much delay in the payment of employee salaries, their benefits, perquisites, and they make sure that if the company is doing good, see like big companies like Adani, Reliance, Tata, obviously the employees would expect some decent increment in their salaries. Like we have the recent news of TCS in the market where they're expecting an 8% hike in their salaries right now. Whether there are financial communities involved in the business information as well. There are certain questions that are usually asked by the internal users. From the operations perspective, is the cash sufficient to pay the bills? That is the normal operating expenses that the company expects to pay in due time. From the employee's perspective, can we afford to give the employees a pay raises? This I gave the example of TCS company in the market, which is having this expectation of 8% hike in their salaries. From the management perspective, what is the cost of manufacturing each unit or product? See, this question is very much particular from the management perspective. For example, if I'm manufacturing, say, laptops, from the laptops, I need to make sure if there's say 20% margin in my product and in the industry margin is 30%, I need to make sure that I take some decent decisions that 20% margin of my business is at par with the 30% margin with the industry to make sure I don't incur losses in future in my company. From the CEO perspective, which product line is most profitable? See, this question is again related to that example which I'll be giving you ahead. That is the DS group, the Dharampa Satyabal group. If one product line is making more profitable, I'll be more inclined towards that product line because that is the most profitable to my business. If I'm in say 4 segments, and one is textile, another is logistics, another is distribution, and the textile is the most profitable segment to me. I'll say I have one more segment, that is pharma industry. And we all know that pharma industry is having the most profitable segment in the market. That segment will definitely be more inclined and be more focused by the CEO of the company. Instead of investing my, say, 20% time in that, I would be more interested in investing 50 to 60% time in that segment. There are external users of the financial information as well. From the investor's perspective, is the company earning satisfactory income? This is important to make sure that the investors get a decent return of the investments made in their company. There are debt holders involved. Debt holders are the debenture holders or the coupon holders, which are issued bonds and the other type of coupons and the instruments which have a fixed pay involved. They make sure that the 10-year is say 10 years. It's a T bond, treasury bond. That to make sure that that coupon that is involved in that particular bond is received in due time, and there is no default involved. There are competitors involved. From the competitors' perspective, say if I'm into automobile segment, and if I just refer to the top niche segment, Audi manufacturers and the BMW manufacturers, BMW manufacturers will always just keep a watch on their competitors to make sure if you have some information like by asking questions, how does the company compare in size and profitability with its competitors to make sure that at all times that competition is at a good healthy stage. Then there are authorities involved, which is the state and central authorities involved over there. Will the company be able to pay taxes in due time to make sure there are no delays in the such statutory compliances? At times, there is a conflict of interest involved in the financial statements from the supplier's perspective and the stockholder's perspective. See, if we just go ahead with the process, once the entire process of financial preparation has been done, we have the financial statements in hand, which is prepared by the management. Then the auditing is done in that part. If we go ahead with the auditing reportings, in the audits, we make sure that the auditors report a true and fair picture of the company. Obviously, that the complete process is done on a test take basis, that cannot be true and correct. Use the perspective true and fair, which is required by the suppliers and the investors. But from the stockholders' perspective, if I refer to the example of Satyam Computers again, where there was this fraud of approximately 7,000 crores involved, there were higher stock prices, these manipulations when the company tried to raise bogus employee expenses and multiple expenses, raise their profits in the company, wherein the companies had bogus profits and the company shares risen like never before. But after the fraud was recovered by CBI, the share market of that particular company fell drastically. Going ahead with the basics of accounting, we have classification of accounts involved. There are two types of classification of accounts: personal accounts and impersonal accounts. Impersonal accounts can further be broken into two parts, that is real accounts and the nominal accounts. With these three types of accounts, we'll be getting to know about the three basic golden rules of accounting, which is followed ahead. Personal accounts. Personal accounts are usually the name of a particular company. Say it could be in the name of a creditor, debtors, which is related to the sales, purchase, etc. We follow a golden rule over here that debit the receiver, credit the giver. If we follow the example over here, Mr. X paid rupees 50 to XYZ Private Limited by check. We would park an entry in the books of Mr. X, XYZ Private Limited company account debit by rupees 50, that is debit the receiver, and credit the giver. From the bank's perspective, that has been paid to, so we'll park an entry to bank, credit the giver. So we have this entry over here, XYZ Private Limited debit to bank account, debit the receiver, credit the giver. Next type of account which we have over here is a real account. Real account usually has a debit balance by default. We follow a golden rule over here that debit what comes in, credit what goes out. If we have to follow this example over here, the company XYZ purchases its third machinery worth 1,000 rupees for cash. We will park an entry machinery account debit to cash account. The debit balance is 1,000 rupees and the cash amount is 1,000. We debit what comes in, that is machinery is coming in. What is going out is cash, 2,000 rupees. Next type of account which we have over here is the nominal account. Nominal account is relates to the all expenses and the incomes that is generated relates to the profits and losses of the company. We follow a golden rule, our third golden rule over here, that is debit all expenses and losses, credit all incomes and gains. See, these are the basics of accounting over here, types of account involved over there. Once we get an understanding of these three types of accounts, I'll be linking these transaction entries with the financial statements to make sure that you people get a good understanding how exactly the reportings are done and accounting information is recorded in the books of accounts. Here we have the summary of the three golden rules that we discussed over there. From the personal account, debit the receiver, credit the giver. From the real account, debit what comes in, credit what goes out. From the nominal account, debit all expenses and losses, and credit all incomes and gains. Accounting and bookkeeping. As we were discussing about the contents of this particular presentation, I informed in the beginning that accounting is somewhere an extension of bookkeeping. Going by the basic definition, where we discuss the accounting information definition, we describe that accounting is involves recording, classifying, summarizing. Thereafter, we interpret the results. Till the process, we are involved in recording and classifying the in accounting information. That part is just the bookkeeping. We can say that accounting information is a broader perspective in comparison to the bookkeeping. The traditional days used to follow the single entry system, but now, not now basically, when the basics of accounting were modernized, we used to be started following the double entry bookkeeping system, where always for a corresponding debit, there's a credit, and for a corresponding credit, there's a debit. This is what we call is a double entry bookkeeping system. For always, there's a plus, there's a minus. For a minus, there's a plus. A system of bookkeeping is so named because every entry to an account requires a corresponding and opposite entry to different account. That's what the double entry bookkeeping says. That's what is being globally followed everywhere in the countries, be it USA, India, United Kingdom, any other country, any other books, IFRS, international reportings, Indian reportings, everywhere. If you just see this example over here, we see that Mr. X has earnings of rupees 100. We would park an entry from the double entry book's perspective. We would debit the cash account by 100 and credit the income statement by rupees 100, where we see that for a corresponding debit, we have a credit, and that's how it goes. We have the features of double entry bookkeeping system involved over here. That present day bookkeeping and accounting, for a debit, we have a credit we already discussed. Effects in at least two different accounts. See, not that only one entry is passed for giving a double effect. It could be a clubbed entry of multiple entries parked together, but the debit is always equal to the credit account. Otherwise, the balances will not match and there will be a difference and balance sheet would not match in the end. We follow the basic equation over here that the assets is equal to liabilities plus equity. That's how the balance sheet tallies and the trial balances tally, which is easy to prepare the financial statements. Following the different example over here, Mr. PQR and within a shop, he purchases a drink beverage from the shop. Transaction from the perspective of both buyer and seller. I think someone has raised a hand over here.
Hi, yes, Bhaskar this side.
Hi, how are you?
Fine, thank you. For just quick understanding, I have a question that what Emerticus management has conveyed the message to you regarding our batch, because this session is supposed to be on the basis of valuation, company valuation.
I was more informed about this particular aspect which I'm discussing right now.
Okay. So are we going to do any sort of valuation thing in this session?
Not really. The valuation thing is not involved over there.
Then yes, then
Yes,
there is a communication gap then, definitely, for sure, because this session is supposed to be on valuation.
I'll just speak to the management. Just give me a minute. I'll just call them.
Sure,
Just give me a minute.
sure.
Over here. How the screen is visible to everyone?
Yes.
All right. So continue with the discussion over here. As we proceed. So the accounting information can be broken into two segments, that is events and transactions. So if we just start with a basic example over here, who's the brand ambassador of Make My Trip India? Could anyone please tell? I'll just refer to the chat box. Anyone?
Alia Bhatt and
And
Ranveer Singh.
right.
Yeah.
So I just ask them to enter into a contract with me that today, from future onwards, for 5 years, they'll be endorsing my product. Will that be an event or a transaction? Up to the signing of the contract. Any answers?
Can you just repeat it, please?
If I just enter into a transaction on basically I enter into a contract with them that in future for 5 years, they'll be making endorsements for my products only, that is Make My Trip India, and I haven't paid anything to them. Will that be an event or a transaction?
Event.
Yeah, right. So basically what we have over here is that once and for all, when we have the contract ready, up till that part, that will be an event. Once the commercial transaction, the commercial terms are involved in that part, that complete event becomes a transaction and we record in the books. While making sure, as the reporting part is concerned of the accounting information, make sure that the ethics are completely fine over there, which is a very important part of the corporate governance. And to solve this dilemma, this is very important to make sure there's no misreporting and the fake claims in the company, if ever floated, are avoided in any part. Here we have an example of the big scam over here, that is Satyam Computers, wherein Mr. Ramanujam Langalingam, he raised bogus claims and the CBI had to inquire in between, where the scam was exposed with an amount of approximately 7,000 crores INR. He made paid receipts, asked employees to manipulate the financial records, and the books were manipulated. Next, we have the accruals concept, some concepts involved over there: historical cost, economic activity, periodicity, and money measurement. The historic cost. Once we record any asset or liability transaction, we make sure that amount is, or that transaction is recorded the original value only, and that amount is not raised or revised. So though there can be divisions depending on the accounting standards that are involved in the reporting segment that we'll discuss on later stage. Next, we have the economic activities. Economic activity is basically what involves that accounting information is something which is to be separated from the accounting business entity and the owner of the particular entity. Then we have the periodicity. Once we have the accounting information ready for the users, we report the transaction annually, quarterly, monthly, depending on the requirements of the users of the financial statement, with an assumption that a company's ongoing business can be divided up. Next, we have the money measurement. Like we discussed in the previous example, that events and transactions, the events are having non-commercial the terms involved, we do not record those transactions in the books of accounts. A fact or a happening which cannot be expressed in book terms of money is not recorded in the accounting books. There are other qualities of accounting information involved, that is materiality, objectivity, and understandable. Materiality, from my perspective, would be quite different from the company's perspective. Say if I just take an example from the materiality perspective, we all know about the Twitter sale in the market. Could anyone please tell about exactly the valuation that has been placed upon that Twitter company? It's somewhere in the billions. Anyone please?
44 billions.
$44 billion is the right answer. That is near about approximately 3 point something lakhs in crores in Indian national rupees. If I just value that amount from, if I just take that amount, that is 3 lakh, $44 billion, out of say 44 billion, that is 3 lakh crores INR, I would say 1 lakh amount is completely immaterial from the Twitter's perspective or Tesla's owner's perspective. That is what the materiality comes in. Materiality defines the threshold or the cutoff point after which the financial information becomes relevant to the decision-making needs of the users. Then we have the objectivity. Accounting information financial reporting should be independent and supported with unbiased evidence. Accounting information must be based on research and facts, not merely prepares an opinion. What we prepare in accounting information should be completely unbiased, regardless of the users, who exactly are the users of that particular accounting information. Otherwise, that information will not be unbiased and will be completely biased. Once the accounting information has been completely recorded, we make sure that it is presented in the financial statement in such a way that it is understandable to the users. Information presented in the financial reports should be concise, complete, and clear in presentation. The information should be presented so as to facilitate the users of the financial information. We have some concepts involved in the accounting info concepts, that is going concern, accrual concept, and the monetary unit. By the going concern concept, we follow that the organization, it is assumed that the organization will continue into the future foreseeable. Next, we have the accrual concept. The income and expenses must be recognized in the accounting period to which it relates, for which we follow the cutoff periods and the financial period, that is 31st March XYZ year. The usual accounting period which we follow in India for the financial reporting is 1st April to 31st March. Otherwise, in the global segment, if you refer, that is January to December, depending on the country we are operating in. Monetary unit. As we discussed earlier, the difference between transaction and an event, the only transaction data that can be quantified is included in the accounting records. The non-monetary transactions or any event that is to be included in the books of accounts, to be excluded from the books of accounts. Other qualities of accounting information. The accounting information should be reliable. Information should be accurate and true and fair. Next, we have the relevant, we make sure the accounting information should be relevant for decision making. If the accounting information is not relevant, then it is of no use to the users, majorly the management group, the CEO. Accounting standards policies should be applied consistently to make sure that these are comparable within the industry and within the company, inter-unit, or outside the company. We have the basic accounting equation over here that assets equity is equal to liabilities plus owner's fund. Asset equity, which includes the fixed assets and the net working capital. Liability segment includes an interest-bearing debt with a short-term or long-term. We have the employee benefits, other liabilities involved, which can be deferred taxes, outsiders liabilities, creditors, debentures, and like. Where the net working capital is the difference between the current assets and the current liabilities. I hope everyone is sure about the current and non-current classification. Next, we have information about the accounting standards boards in India. Once we have the accounting information, trial balance ready in our hand, we make sure that the accounting information is recorded in the financial statements, depending on the quarterly or the annual reporting period. For this reporting, we follow the accounting standards in India, which is Indian accounting standards. Earlier, that was IGAAP. And if we refer to the global level, it can be IFRS or the US GAAP. We follow the prudence concept over here, all over the globe, that anticipate no profits and provide for all possible losses. This basically classification, or I would say that standardization, is done to make sure the user sitting in India can understand the balance sheets or the financial statements of the entities operating outside the country, and the people are sitting outside, or the investors outside the country, can understand the balance sheets that were prepared within the globe. Next, we have the information regarding the transitional phase. Earlier, long time back, when we used to prepare the T-shaped account, thereafter came the Schedule 6, which we prepared the long format, then came the Schedule 3 from the company's back perspective. Then accordingly, after 2015, there was introduction of Indian accounting standards in line with the International Accounting Financial Boards. For this, the listed companies were targeted from 1st April 16 as a transition date, having net worth of 500 crores or more, and unlisted companies having net worth of 500 crores or more. Thereafter, from 1st April 17, the lower companies, that is the listed companies having less net worth less than 500 crores were targeted. Thereafter, the unlisted companies having net worth of 250 crores to 500 crores were targeted. As we proceed ahead, we'll get an understanding of what exactly is the difference between standalone financial statements and the consolidated financial statements. In the consolidated financial statements, we have multiple components of the investments involved, which can be the holding company, subsidiary company, joint ventures, associate companies of the listed and the unlisted companies covered here. It is very important to note that once the accounting standard, that is the Indian accounting standards, or in short we refer to as Ind AS, have been adopted in a particular group. Say a group is basically investment of, from a holding company's perspective, that is a joint venture, subsidiaries, associates, and anywhere. If we ever do the big group over there, if any component that is say associate that have having investment of 20%, and that associate at Indian accounting standards can get compliant with, because the net worth situation. In that situation, the entire group will be required to comply with the Indian accounting standards framework. This is a basic difference between the earlier GAAP that was followed, and then we had the IFRS. Now we refer to the complete flow of transaction, from beginning from the transaction and preparation of the final books of accounts, that is financial statements, which includes the profit loss, balance sheets, cash flow statements, statement of changes in equity, and the notes to the financial statements. Once the event has been differentiated from the commercial and non-commercial perspective, we record that entry as the basis of the transaction. Once the transaction has been identified, we recorded that entry in the journal ledger. From that ledger, we prepare books of accounts, and thereafter that entry is posted into ledger, which is the secondary books of accounts. From once the ledger posting has been done, following the double entry book system of accounting, we prepare the trial balance, and on the basis of that trial balance, we prepare the final accounting financial statements that we have over here. Following ahead, if we get an understanding of basically what is a trial balance. Trial balance is a summarized statement prepared by extracting the debit and credit balances as on a particular date. And always remember that the trial balance is on a particular date and profit loss is for a particular period. The debit should always be equal to the credit. That is how we follow the double entry system. Otherwise, the books will not match and trial balance will show an error. Do not check the authenticity of the transaction. The statement is true as on a particular date only. This is basically why they will prepare the trial balance to make sure that the entire balances are intact and the debit balances matches with the credit balances. Then we have the components of the financial statements. First, we have the income statement, that is the profit and loss account. Next, we have the balance sheet. The third part is statement of shareholders fund, or we refer it as statement of changes in equity as required by the legal compliances. Then we have the cash flow statements. Income statement. Income statement includes basically the revenue, expenses, income, earning per share. Earning per share is basically the requirement of the accounting standards that are required domestic or the global level, as per the requirement of Ind AS 20, which we report in the income statement. Then we have the balance sheet, which reports the assets, liabilities, net worth, also the shareholders fund. Next, third component, we have the statement of shareholders equity, which represents the changes in shareholders equity or interest in the entity, which it reconciles the difference between the opening and the closing balances, which starts from the opening reserves, add less profits and losses, then we show the closing profits and losses depending on the transactions that have happened during the year. Lastly, we have the cash flow statements, which show an in and out of the entire fund flow in the company, that has happened down the year. This is further divided into three activities: operating activities, investing activities, and financing activities. Once the transactions are identified, recorded, and summarized, 4 financial statements are prepared from the summarized accounting data. That is the income statement, balance sheet, cash flow statement, and statement of owner's equity. If you go with the basic understanding about these components, income statement represents the revenue and expenses resulting net income or net loss of a company for a specific period of time. Next component, the balance sheet. It reports the assets, liabilities, owner's equity of a business enterprise on a specific date. Cash flow statement, which summarizes the information concerning the cash inflows, receipts, and outflow payments for a specific period of time. The last component, that is statement of owner's equity. It summarizes the changes in owner's equity for a specific period of time. The notes are always an integral part of the financial statements, which basically refers or give a brief understanding what is happening in the accounting financial statements. The question comes to our mind: which authority or which organization is behind the preparation of these accounting standards? It's the Institute of Chartered Accountants of India, which has been setting up the accounting standards for the country, the generally accounting principles of accounts, standard framework of guidelines for the financial accounting are issued by ICAI in short. There are certain financial terminologies involved. The definitions of financial terminologies which you may come across in the financial statements are as follows. First part is the sales or revenue. Sales or revenue is to refer the total value of the products or services sold by the company. Companies may also add income earned from passive sources, example royalty, sales may refer to it as total income. This sales part not just includes the operating part, but it can also be the non-operating part, like the income or income interest generated on the fixed deposits by the company. Next component that we have with us is the overheads. The overheads are the ongoing expenditures incurred for the purpose of running of business operations and which can be fixed and variable. These are the supportive business expenses to make sure that the core of business operations are never shut. These are the normal administrative expenses, sales and sales related expenses, and like much more. Third we have is the profit. Profit refers to the surplus of income over expenditure. If expenditure is greater, it refers to as losses. Profit basically is just the difference between the income side and the expenses side. That is the difference between the two. If the expenses exceeds the profits, that turns out to be the losses. Profits are categorized at multiple levels to aid better analysis of financial performance. Next, we have the assets and liabilities. Assets are those components of the financial information on which the entity has control and has expects some benefit out of it. It refers to the properties, financial investments, other financial claims that a company has, which can be plant and machinery, furniture and fixtures, books and periodicals, computers, etc., which can all be tangible, intangible, current, non-current. Intangible can be multiple, which may be infringement rights, business rights, goodwill, like other. The last component which we have over here is the liabilities. Liabilities are the amount that the company owes to the third party, like creditors, tax liabilities, debt obligations, loans, etc. Not just the third parties, it can be the liabilities toward the internal users as well, which means like the employees as well. Next, we have the debt. It represents the liabilities that are interest bearing. To smoothen the running of any business, we raise debt instruments from the market, which can be debentures, bonds, coupon-bearing instruments, and like. These are the fixed term payment that is required out of it. Next, we have the equity. Equity represents the amount of assets that belong to the shareholders after paying to the third party. Whenever, if we just refer to the legal compliances of the liquidation format or the insolvency bankruptcy code in the defined in the IBC code, the equity segment is referred to as a last priority segment, wherein whenever the in IBC is happening or liquidation is happening, equity settlement is done in the last. First priority is given to the outsider liabilities, then tax compliances, then the debentures, then preference shareholders, and lastly we have the equity shareholders. The last segment which we have over here is the capital expenditure. In short, we refer to that as a capex. It is an expenditure such as purchase of fixed assets, etc., that produces a benefit for a beyond normal operating cycle of a company. And these expenses are generally not charged to the profit and loss and are rather capitalized in the balance sheet in the name of assets. Though these assets are amortized or depreciated over the useful life of that particular asset in the name of depreciation or amortization charges. Next, we have a basic difference between assets and liabilities. An asset is something which an individual or company owns, and liability is something which an individual or company owes. Both these assets and liabilities can be further divided into two segments, that is current and non-current. Current and non-current classification, if we go by the legal definitions, depends on the operating cycle, or which is generally taken out to be 1 year, depending on the business of the entity. Assets calculation is done, liabilities plus owner's equity. Liability is equal to assets minus owner's equity. Some examples attached over here. Assets are building, cash, goodwill, account receivables, investments, and like. From the liabilities perspective, some examples are long-term borrowings, bank overdrafts, account payables, etc. Going by the definition or basic equation, company assets is equal to liabilities plus owner's equity. That's how the entire balance sheet is built up. The basic books of entry which we have in the financial statements preparation are journal, ledger, and cash book. Journal is basically the original book of entry where all the transactions are recorded, or the first entry book of any entity. It records the transaction as and when they occur. For recording these transactions, journal used multiple ERP systems like Tally, SAP, Oracle, QuickBooks, and multiple. Ledger is the final resting place for all transactions, and trial balances prepared from the account balances in the ledgers. Once the journal has been prepared, we proceed to the second step, that is the ledger posting, from wherein we prepare the trial balance. Next, we have the cash and bank books, the book of original entry and the final entry for all bank and cash transactions. Records the cash and bank transactions as and when they. There can be situations wherein the transaction with which we have in the books from the bank's perspective and the past book shows a difference, for which we prepare the bank reconciliation statements. And for that, I must say, for at the big MNC level, there are multiple teams involved for reconciling the differences at the year end or the reporting end period. This is the basic transaction flow after the event is recognized, when we record the transaction in the journal, as we discussed earlier. Entry, books of primary entry, that is a journal and subsidiary books. Then ledger posting is done, books of secondary entry. Then we have the trial balance. Final accounts are prepared from that trial balance, profit, loss, and balance sheet, cash flow, and statement of owner's equity. Next, we have a basic specimen of a profit and loss statement prepared in a normal statement following the US GAAP. This entire sales segment involved over there, which can be operating and non-operating. From that segment, then we charge the cost of goods, that is the purchases, net of return outwards, gross profit. That GP ratio is tried to made intact with the previous years, and from that information we use to make sure that the GP ratio which we have with the company is intact with the industry, to make sure we don't make much losses and we are at par with the competitors, or we have a strategic edge. Next, we charge the normal expenses like electricity, telephone owing, depreciation, discount allowance, rent, wages, and we reach with the final profit, that is a net profit. Then we have the use of financial statements. From the investor's perspective, we want to know about the financial health of the business. From the creditor's perspective, get comfort about the lending credit to the business, that the lending which has been made from us to the company is made sure that we get the timely returns from that investments and the credits. From the manager's perspective, get information on the performance of the business. Like if we just give an example of DS Group, that is Dharampa Satyapal Group, that is into the segments of tobacco, I would say, or Rajnikanda. They had this value edge over this specific line of business on that particular segment, and they use that same value chain to release their second product, that is the pulse shots toffee, which we sold in the market. They use the same value chain analysis to make sure that this candy is introduced in the market and spread well. That's why the manager's decisions are very much important in the market. Use of financial statements. From the employee's perspective, to know how well the company is doing, that is a bonus factor involved for every employee. From the auditor's perspective, to give a report which is an independent opinion on the position of the company to make sure the accounts are reported with true and fair result. Then we have the government to make sure that all the information on the taxes to be collected from the business. Once the auditors finalize the balance sheets or the financial statements of the company, that financial statements along with the return of the company is submitted on the income tax portal. And with that information, the government derives a tax that was required to be paid and the tax that has been paid. With that information, government decides the refund or the chargeable amount or the demand that is to be raised on the organization. Accrual versus cash basis of accounting. Cash basis of accounting and accrual basis of accounting has a major difference involved. Usually the cash basis of accounting is used in small organizations like firms, LLPs, wherein not much transactions are happening. It recognizes the revenues when cash is received and then when the expenses are actually paid. The accounting is not done when the expenses or the revenues actually become due. It does not recognize the accounts receivable or payable because no accrual concept is involved over there. Simple to maintain, used by the small business, easy to determine the transactions have occurred or not, easy to task how much the cash the business has, easily tracks how much the cash the business has. Then we have the accrual basis of accounting, where the amount that is the expenses of the revenue, which is the nominal accounts transactions are recorded when they're actually earned. They are more commonly used than cash system, give more realistic idea of income and expenses, provides long-term picture of the business, doesn't provide any awareness of any cash flow, can be derived, they can be deceived, business can appear profitable even when they're empty bank account. Because basically, not the actual payment has been done, but we record the transactions on the accrual basis over here. Next, we have a simple life cycle of a transaction, where we start with the journal ledger, journal entry, proceed towards the ledger, trial balance, reconciliation statements between the balances of the third parties and our books. And finally, the financial statements are prepared with the final adjustments that are required to be made in the books. Now we have a basic example of a balance sheet reported, which used to be followed in T-shape account long time back in year 2006. Balance sheet is a statement of assets and liabilities of business at a point of time. And the total assets and liabilities always equal to that is balance sheet always tallies. If at any time there's a difference between the assets and liabilities, our balance sheet will not tally, and that will lead to a misreporting or misrepresentation. Okay. So there are some key balance sheet items involved. Fixed assets. Fixed assets are those which are acquired for long use in the business itself and not for resale. For example, land and machinery, land and building, etc. At the corporate level, I would rather say that these are more referred to as the supporting assets of the company, because these support the actual operations of the company. Current or floating assets are those which are meant to be converted into cash as soon as possible. For analyzing these current or floating assets, we use ratios like current assets ratio, quick ratio, liquidity test, asset test, and like. Some examples involved over here are stock and debtors, etc. There are liquid assets as well, are those assets, current assets, which are already in the form of cash or which can be readily converted into cash. These are the government securities. Some examples of the government securities are the treasury bonds, 91, which usually have a tenure of 91 days and temporarily issued by the government to maintain the liquidity. Next, we have the wasting assets, which are those assets which have a fixed content, which are usually the coal mines. The value goes down as the contents are taken out. Once the maximum extraction from the coal mine is done, that coal mine is basically a wasting asset because the value is going down day by day. We are digging into it. Next, we have the intangible assets. Those are those assets which cannot be seen or touched or felt. We have multiple accounting standards over here that in this here multiple reporting segments involved. And basic example of that intangible asset is goodwill. Next, we have the fictitious assets, are the valueless assets but shown as assets in the financial statement, useless trademarks or expenses treated as assets like preliminary expenses. These assets, or I would rather say expenses, are those balances which have not been amortized or written off in the books of accounts. And hence, they reflect a debit balance and are represented in the balance sheet and not in the profit loss. Liabilities, as we discussed, are the claims against the assets. They are existing debts and obligations. Whenever there's an unfortunate situation, like as we discussed, liquidation or winding up, liabilities or the external liabilities are paid first, then we are paid to the internal users of the financial statements. Any question that we have so far, I would request to ask. I guess no. Non-current current classifications. I guess we have a chat box. Okay. Moving ahead, we have current and non-current classification. If you go by the normal understanding of this non-current and current classification, current assets or liabilities are those which are expected to be waived out in 1 year, and the long-term assets or liabilities are expected to be settled beyond 1 year. Or if we refer to the operating cycles, that depends on operating cycles, which can be current or non-current, depending upon the operating cycle. Next, we have the classification of liabilities. We have fixed and long-term liabilities, current and contingent. Fixed and long-term liabilities are those liabilities which are payable on the termination of the business, such as capital of the proprietor, whereas long-term liabilities are those which are redeemable for a long period of time, example, long-term loans. These liabilities can be in the form of debt, obligations to the third parties, which generally exceeds from 10 years to 15 years. We have current liabilities. These are the liabilities which have to be redeemed in a near future, usually within a year. Example, trade creditors, bank loans, bills payables, etc. We have contingent liabilities. These are not actual liabilities, but these are becoming actual liabilities depending on the happening of certain events. If such events do not occur, no liabilities incurred. If I just give a basic example of this contingent liabilities, these are not recorded in the books of account. Rather, a footnote is given to the same if we expect that these may turn out to be a liability in the future events or transactions. If I just give an example over here, we all know about the Vodafone case that was existing at the global level. For Vodafone, in 2007, this transaction has happened where Vodafone acquired CGP Investments, which we'll be discussing in about the further slides in the next session, wherein it acquired CGP Mauritius, and it was claimed CGP was required to pay the capital gains tax to the income tax authorities. Thereafter, Mr. P. Chidambaram made an amendment to Finance Act finance at 12 to make sure that that company, that is Vodafone, pays that liability. Though at the global level, we lost that case and we are not able to pay anything for that. That liability or that information was required to be reported in the form of contingent liability in the books or financial statements of Vodafone India Private Limited for year and year. Next, we have this component statement of owner's fund, which shows the reconciliation of the opening and closing balances of the owner's fund, which can be common stock, paid in capital excess of par, retained earnings, treasury stock, which form the total stockholders' equity. Which this movement can be due to owner contribution and income, withdrawal and expenses. Discussing about the income statement, profit and loss. Total revenue minus total expenses turns out to be the profit. If the revenue is less than the expenses, then it becomes the losses. There are certain objectives involved in the profit loss statement. The objectives of profit and loss account point out the progress registered by the company. We have the balance sheet, which is prepared in one moment in time, basically in one date, and rather the income statement is prepared for over a period, which can be quarterly, monthly, annually, or depending upon the reporting that is to be done for the financial statements. We have the PL objectives to report, that is the sales, net income, earning per share, that is required by the Indian Accounting Standard 20 requirement, which discloses the information about revenues, expenses that are a direct result of business operations. We have few examples over here, like on September 1, someone invested rupees 15,000 cash in business, which he named SoftBite. There's an increase in asset cash, 15,000, and equal increase in owner's equity, 15,000 capital. Following the double entry system over here, we have raised the assets by 15,000 and owner's equity has been raised 15,000. Second example, SoftBite purchases computer equipment for rupees 7,000 cash. Earlier investment was made with a capital of 15,000 and now 7,000 cash has been invested into office computer purchase. Cash has decreased by 7,000 and asset equipment is increased by 7,000. That's how the double entry system works and the balance sheet tallies always. Third transaction, SoftBite purchases computer paper and supplies expected to last several months from ABC Supply Company for 1,600 on account. The asset supplies is increased by 1,600 and the liability account is increased by the same account. This is basically an accrual system of accounting followed over here, where the supplies have increased by 1,600 and the liabilities have increased by 1,600. SoftBite receives rupees 1,200 from customers for the program services it has provided. Cash has increased by 1,200 and the capital has increased by 1,200. This capital is basically not exactly the capital. It is a statement of profit and loss which has increased over there. And with the increase in cash, we have an increase of capital, that is 1,200, rooted from the statement of owner's equity. SoftBite receives a bill for rupees 250 for advertising its business, but pays the bill on a later date. Account payable is decreased by 250 and capital is decreased by 250. This is another accrual entry followed over here, where the advertising expenses is increasing by 250 through profit and loss, and the account payable entry has been booked for the same. SoftBite provides programming services for rupees 3,500 of customers and receives cash rupees 1,500, the balance payable on account. Cash is increased by rupees 1,500, account receivables increased by rupees 2,000, and capital is increased by 35 account. Basically, this is the compound entry of part over here. Expenses paid in cash for September are store rent 600, salaries for employees 900, and utilities 200. Cash is totally decreased by 1700, and the capital is increased by the same amount over there. SoftBite pays its advertisement bill 250 in cash. Cash is increased by 250 and accounts payable is decreased by the same amount. That's how the basic double entry system is always followed, and the balance sheet always tallies. Sum of rupees 600 has in cash is received from customers who have previously been billed for transaction number 6. Cash is increased by 600 and accounts receivable is decreased by the same amount. Mark Dossett withdraws 1300 in cash from the business for his personal use. Cash is decreased by 1300 and the capital is decreased by the same amount. And this basically decrease in capital will be part in the statement of owner's equity by the way of drawings, 1300. I just need 1 minute to settle my technical glitch over here. Just 1 minute, please. Yeah, I just sorted now. Is my voice clear?
Yeah.
Coming back to the components of the financial statements, we have the next component, that is cash flow statement. If today I'm investing, say, 100 crores into some business, I would expect to know where that exact 100 crores is going by the year end. To make sure, we divide the cash flow statements into 3 segments, that is operations, financing, and investments. Cash flow is important because cash profits are different from the accounting profits, for which we have 2 methods of preparing these cash flow statements, that is the direct and the indirect method. Cash flow is affected by the transactions which are not related to profit or losses. Cash flow statement shows the reconciliation between the opening cash and the balance and the closing balance as of a company. For example, I'm investing into a new plant, raising new finances through issue of equity shares or debt. The first transaction that is investing in a new plant, that would be an investing activity. Raising new finances through issue of equity shares or debt, that will be a financing activity. That's how the classifications of the cash flow statement is done. Next, we have the classification of the 3 sources of the operations, that is operations, investments, and financing. Operations are those basic transactions which relates to the core business operations like sale, purchase, etc., taxes. Investments can be if I make an investment into shares of, say, some another subsidiary company to make it my subsidiary or joint venture, or normal transactions, say if I make investment into mutual funds, that will be my investment activities. Then later we be having this financing activities, which can be if I raise, say, if I debt from, say, outside sources or coupon bonds, that will be a financing activities. Cash flow categories. Investing activities represent the acquisition and disposal of long-term assets and other investments not included in cash equivalent. Category: cash invested in purchase of fixed assets, financial investments, and amount realized from sale of such assets is basically the finance investing activities. Even if I invest in some say fixed assets, that will be my investing activities, and on some later date, I sell off those investments or fixed assets, that will also for disposal and acquisition will both form part of my investing activities. Next, we have the operating activities, which are the principal revenue providing activities of the entities. Categories include cash flow generated through sale of goods or services, depending on the producer, trader, service provider. Amount paid towards procurement of the raw material, which is required for main operations of my entity, which can be service or depending on the transactions that are happening in the company. Wages paid or other expenses incurred, which is basically the overheads of the company, which I'm paying for my core operations. Next, we have the financing activities. The activities that result in changes in the size and composition of the contributed equity, borrowings of the entity. This category represents the borrowing and repayment of loan and issue of buyback of equity shares. In the operational activities, we take the base as a net income, profit before taxes or profit after taxes, depending on the transactions that are being processed in the books. The non-cash items are also the made adjustments to the operating segments of the cash flow statement. Some examples are accounts receivable. If I book an entry, say credit sales, and mark an entry accounts receivable debit to sales, that is a non-cash transaction. If we see that there is an increase under my working capital changes, so that increase is reduced from my operating activities to make sure that I get actual cash transactions only. And here we see that these receivables are reduced from the net income. And on the similar grounds, we also include the account payable, depreciation and amortization, that is a non-cash transaction at the operational level. Next, we have the investments. Property, plant and equipment, which we refer to as the CapEx, capital expenditure. Investors prefer companies that generate cash flows primarily from business operations, not investing in financing. If I invest in property, say building and purchase or plant and machinery or any equipment, that transaction is reported into cash flow statements and the investing activities over there. And that's how cash flow statement is prepared. The last business activity detailed in the cash flow statement is the financing component. Provides an overview cash used in the business and financing. Like if I raise a debt approximately of say 10 lakhs, out of that 10 lakhs, where I'm using that 10 lakhs to finance my investments and operations. This is how the financing operations defines my operations and investments. Investors use this to find out the amount paid in dividends and share buybacks. There are certain restrictions placed in the Companies Act and the major statutes wherein I cannot use the amount raised by one source for another purpose other than the defined in the prospectus of that particular raise. Cash obtained or paid back from capital fundraising efforts is also included. Cash flow preparation process. In preparing cash flow statements, we have two processes involved, that is the direct and the indirect method. The direct method is very simple and not much related to complexities, wherein the cash flow statement is mere summarization of the cash ledger, wherein we get the cash and pay the cash, we record only those transactions. No accrued transactions are made, no other transactions of year and unbilled, unenumerated transactions recorded in that particular cash flow statement. The second method which we have over here is the indirect method. Each component of cash flow statement is derived using the balance sheet and income statement. Most companies calculate the operating cash flow using indirect method. To be very honest, over the globe and maximum companies follow these cash flow statements in the indirect method only. In the later part, we refer to the balance sheets of the balance sheet and financial statement of Airtel company, where we will get an idea how exactly the indirect method cash flow statement is prepared. Here we have this example of the Airtel balance sheet, which is prepared in the Indian Standards of Accounting Reporting Framework, wherein earlier in the IGAAP framework, the liability segments and the equity segment were reported in the first part, but now the assets including current assets and current and non-current assets are recorded in the first part. We see over here the notes are integral part of the balance sheet. This starts from here, and further the current and non-current assets are further broken down into financial and non-financial assets. Next, we have equity and liabilities component of the balance sheet, bifurcated into current and non-current liabilities, and further bifurcated into financial liabilities and the non-financial liabilities. Here we have the standalone profit and loss of the operating company. If you refer over here, the reporting over here, it is completed in the Indian account reporting framework. The loss has been defined over here to 51,976 over here. For preparing the cash flow statement, we refer the figure over here, which I'll just show, just 1 minute. The losses, when we have the other comprehensive income. Other comprehensive income is basically those gains and losses which were not expected or not related to my business, but that happened out of all of a sudden. We have reporting standards, India is 109, and other reporting standards in Schedule 3, wherein we report the transactions and the other comprehensive income. And with that, we prepare the basic earning per share. Here we have the cash flow statement. The basis has been taken the loss before taxes over here, that is 184,652. We have adjustment for the non-cash items like depreciation and amortization, finance costs, interest income, that is related to my other heads, that is the financing component. Dividend income has been decreased from there and added to investing activities. When finally we reach to the net cash generated from operating activities, then we follow the investing activities, which we report transactions like PP acquisition, WIP, intangibles, tangibles, loan prepayment to subsidiaries, dividend received, which was transferred from operating activities to investing activities, interest received, and like. The final part which we have over here is the financing activities, where we have the net proceeds from the issue of shares, which is 0 over here, but which was reported as in the last reporting period. Proceeds from borrowings, proceeds from lease liabilities, short-term borrowings, other finance charges, dividend payments, and like. This is how we prepare the cash flow statements and show a reconciliation of the opening and the closing balances. I guess we can take a half an hour break over here and get back with us at 2 p.m. All right?
Sure.
Thank you.
Sure.